The Fed's mistake in December, Courtney, was saying it was going to continue to hike in 2019 and the fact the balance sheet was going to be on autopilot. That was the big mistake. Had the Fed raised rates in December and said they were effectively on perma-hold and they were in the midst or in the process of deciding they were going to let that balance sheet runoff stop, the markets would not have reacted as they did. So I don't think December itself was a mistake. It's what they said in addition to it, and it's the forward-looking aspect of what troubled markets that caused the big correction. And the Fed prudently, as I'd argued at the time, reversed course.
And so we have this meeting coming up here, and they look at a lot of things. They've got a dual mandate. One of the things they look at is the strength of the data. We just got this GDP report up 3.2%, much stronger than economists had expected. But you think that that's not really the full story, that the underlying economic data is actually much weaker than that? What do you mean?
That's right. So, Courtney, if you look at effectively private final demand, it was barely up more than 1%, which is what I thought GDP was tracking in light of production. GDP is a measure of output. Production in the first quarter, if you look at the Fed's data, actually was negative. And therefore, when you look at the numbers and you see that inventories accumulated for a substantial portion of the gain, and you had a big jump in government, those are two areas, for example, where you're not going to see it repeat in this quarter or next. So one of two things happens, Courtney. One, either we revise this number significantly lower, which is possible. This is the first print, and we've got many revisions still to come. Two, and more likely, we see a much weaker number in Q2, and I would caution investors then to effectively average out both quarters. That's going to be a much better gauge of how the economy is performing.
So for investors, as they're trying to take a look at their portfolio ahead of this Fed meeting and the ultimate commentary that comes out of it, what are you expecting? Is there anything here that could give you reason to think that the Fed is going to change course, do something different than they did in December, as you've suggested, maybe learn from some of their mistakes and shift their commentary or their focus at all?
The risk, Courtney, would be that Powell says more than he's supposed to. If he stays to the script of we're not moving rates this year, we only have one hike in the forecast for next year, but policy can move in either direction depending on the data, the markets will be fine. That's my hope, that the chair will, he learned from his miscommunication last fall, and he'll be much more nuanced and much more non-committal. And if that happens, then the markets will just treat this as a non-event, which is my guess. Looking forward later in the year, given the drop I see in inflation, my guess is the Fed will be cutting rates by year end. And that, I think, as you may have alluded to earlier, is effectively priced in the market when you look at where 10-year yields are currently trading and, of course, where the 2-year Treasury is as well.
And that's a good point on inflation. They have this dual mandate, and inflation has been trending downward. We're going to get another reading today. Do you think it's appropriate for the Fed to change course based on what's going on with inflation, or what are your expectations there for what we might see today and going forward?
Yes, Courtney. I mean, if you look at the tightening cycles over the last 30 years, the average time from the last hike to the first ease, whether it turns out the economy goes into a recession or whether the Fed engineers a soft landing, the average time between the last tightening and the first easing is about 7 months. In the last cycle, it was long. It was 14 months between the last hike and the first ease. The market's basically saying it's 12 months. The last hike was December. They said the market's going to cut this December. That seems very reasonable, especially if inflation, which has been consistently undershooting the Fed's mandate in this entire business cycle, continues to drift lower, which is what I anticipate.
Early in the program, we spoke with Eunice Yoon over in Beijing, and she gave us an update as to what we can expect with those trade talks between the U.S. and China. How are you basically modeling what your expectations are for the outcome ultimately of these talks and how it reflects U.S. economic growth and therefore Chinese economic growth? Because there's just been worries for so long about the outcome of this. And how are we supposed to be positioning in advance of knowing what this real outcome could be?
Sure. So Courtney, I've said two things. One, all along, I thought this was a negotiation. There's a little bit of political theater, but it was a negotiation, and that there would be the broad contours of a deal reached at some point this year. And that's still my view, and given what I've been hearing and seeing, that could happen within the next few weeks or month or so. The more important factor, again, is the Fed. Business cycles are largely determined by liquidity and what monetary policy is doing. And therefore, to me, the pivot in the Fed is what has stabilized markets. And the trade trade discussion never really, in my mind, was something I had to model. It was really always about the Fed and what they were doing, and to some extent what other central banks were doing. And unless there was going to be a full-blown trade war, which I never anticipated, I just think markets, or rather investors, have focused way too much attention on those factors.